Hello everyone, good afternoon. Thank you for joining our webinar for Academy Trust Updates 2025. We can see that we're still waiting on some attendees in the waiting room, but we will start now with our introductions and hopefully more people will join as we progress through the introductions. I'm Carly Pincus. I head up the education sector at BKL. I deal with Academy Trust audits and other services we provide for academies and schools as well.
And I'm Johnny Weatherall. I'm a senior manager within the academies and schools sector. I've worked in the sector since 2016 and dealt with single academy trusts, multi-academy trusts, schools with special needs focus, as well as all the ad hoc regulation requirements such as internal scrutiny, Annex Gs, etc. Part of the wider not-for-profit team within BKL. And just before we kick off in earnest, there's a Q&A section available as well. So if you have any questions, just drop them in the chat, and we'll answer those probably at the end. But if they're relevant to us as we're going through our presentation, then we will incorporate them into our webinar today.
Just a little bit about BKL before we start the content of our webinar today. I know that there are various attendees today that are clients, but we also have trusts that have joined that are not clients of BKL at the moment. So just to give you a little bit of an introduction, we're a firm now made up of 400 plus people. We're within the UK top 40 accountants and advisors, having offices in North London and the City of London as well. You may be aware that we were the first accountancy firm that received B Corp status, which is of course of interest, particularly in this sector. And we are members of the DFK International Network, which is not only just a benefit to us as a firm, but of course a benefit to our client base as well. In terms of what we'll be covering today, we're going to start off with updates to the Academy Trust handbook. Johnny will be talking us through that. Then I'll be covering updates to the Academy's accounts direction, and then we're going to look at pensions updates, what's changed, and just some key points to take away in terms of pensions for Academy trusts. Then we're going to look at sector updates, including the Charities SORP updates and other updates for the sector. And then, as Johnny said before, we will have a Q&A session at the end. We will be monitoring the questions that come in. We have been sent some questions in advance that we're aware of too. If anything's relevant to answer as we're going through the slides, we will. Otherwise, we'll wait to the end to tackle all the questions.
So to kick off then, we're going to have a brief run through the Academy Trust Handbook 2025. This is effective from 1st of September 2025, so the academic year that has just started. It's a website and a website post and mailing was sent out by ourselves at BKL surrounding this during the summer, and this is going to form the basis of this section. If nobody has a copy, I'm sure everyone here will have a copy or has access to a copy. If you don't know, please Google Academy Trust Handbook and click on the link with gov.uk and it's all there laid out in easy to read with effective bookmarks. Now, essentially, there's no significant changes. That's the headline figure. There's no changes that would require a successfully run Academy Trust to change how it operates. Just before we move on, that's just to emphasise the word successfully. Obviously, as you all know, as business managers or key stakeholders within Academy Trust, issues always do arise. Whether they be regularity issues, funding issues, deals with pupil numbers, or staffing issues, for example. And as your advisors, or as any good advisors would, that we want you to reach out to us with any questions any time throughout the year to see that we can to see how we can help you. We don't want you to wait to the audit at the year end, but please do get in touch with us. What the Academy Trust Handbook does mainly is offer clarity to trustees in 3 areas, which we'll go into in a little bit more detail. Their roles and responsibilities, the financial requirements, and some regulatory concerns, and the intervention powers of the DFE. That can be seen from the bottom. I'll quote a couple of numbers here now as to where the references are as to where they are within the Academies Trust Handbook. 6.21 allows the DFE the Department for Education, they can recover funds in the event of irregularity or fraud being identified. Obviously, if there's if fraud is perpetrated, then you would expect that to be the case, but also irregularity. So if there's an exception to your regularity report, for example, there is then the power. DFE do have power if it is so relevant to recover funds. So again, it's coming back to essentially making sure that you as trustees and as financial managers and key stakeholders within the Academy Trust remain on top of all the requirements and regulations. Connected to that, again, the option to issue a notice to improve solely on educational grounds has been removed. So there has to be some financial element, financial deficiency in order to receive the dreaded notice to improve. And if this is received, please do contact your relevant advisors as soon as possible, and they will be able to help you through the processes that are necessary. So going into a bit more detail on the roles and responsibilities, the first bullet point, managing public money. There's a link to within the Academy's Trust Handbook to an HM Treasury document called Managing Public Money, and I recommend that all accounting officers specifically would read that. And essentially, all of these, the first 4 bullet points are linked to the role of the accounting officer and their responsibilities. Accounting officer, of course, being in 99% of the cases the head teacher of the trust. Again, emphasises that specifically their duty to raise concerns that they do have initially with the trustees, with the members, and then ultimately the department if necessary. And sections 1.36 and 1. through to 1.38 of the handbook emphasises that the accounting officer must take personal responsibility in ensuring that this is the case. There's within the Managing Public Money document, there are some, and the handbook, there are some updated definitions concerning regulatory, proprietary, value for money, and feasibility. And I would ensure that all the accounting officers are fully aware of what these are. Essentially, in a nutshell, regularity is ensuring that the proposed transaction is compliant with the framework of authorities. So ensuring that the transaction is fully necessary for the managing of the school. Propriety, ensuring that the proposal that meets the highest standards of public conduct and relevant parliamentary control procedures and expenditure and expectations. You are being given public money to educate the children, ensure that money is not misspent. Value for money, again, ensuring that you have appropriate benefit, appropriate backups as to why the transaction took place and at the level it was. Doesn't necessarily mean it has to be the cheapest. It's just ensuring that you will have considered value for money and putting a case forward as to why a proposed transaction, especially ones above the tendering thresholds, are relevant and undertaken. And then feasibility, how relevant, how possible it is for the proposal to be implemented accurately, sustainably, and to the relevant timetable. It's no good getting the cheapest or the best in terms of reputation if it cannot be delivered. And there's, again, the handbook is replete. There's lots of links and tools in relation to the above. The Managing Public Money document, I think, is a must read, especially chapter 3. And in appendix 3.1, there's a link again, which is to the Confederation of Schools Trust, which goes through the role of an accounting officer, which again, I would recommend that if you can't get your head teacher to read it, at least try and read it yourself, so you know what the role is. Moving on then to estate management. This is the 5th bullet point down. It's been a hot topic over the last previous couple of Academy Trust handbooks. Again, you have an estate, you are managing an estate of the school property, and which is an asset and a mechanism to deliver outcomes for pupils, and it's ensuring that you have there's further guidance in relation to that as to what the standards that you have. There's advice, there's different tools. Again, there's a lot of links within sections, the sections of the Academies Trust Handbook, which I would recommend that you would read. There's links to condition improvement funds and the relevant terms and conditions. Not as relevant now, but there was lots of data on RAC. It is a section that I would recommend that is read in detail. Again, this is more a heads up for the forthcoming years. Confirmation that the trust must have an understanding and be working towards meeting the 6 core digital and technology standards by 2030. To list these are broadband switching, network switching, wireless networks, cybersecurity, filtering and monitoring, digital leadership and governance. As everything becomes more focused online, then it is the onus going to become upon trustees and the senior leadership team to meet towards their these criteria to ensure that your digital information is safe. Obviously, it's a very key point now, but then these key competencies that are going to be introduced in the next over the next 3 or 4 years. If you need help in doing those, then you need to. Now's the time to ask. Now's the time to get that all in place. As we all know, that sector is ever changing. And finally, linked to guidance and support on sustainability to help trusts ensure they have a climate plan in place. We'll touch on this a little bit more throughout the webinar, but essentially there are a lot more regulations and reporting requirements that are coming in regarding sustainability. Large trusts at the moment all have to include certain bits within their trustees report. As a basic example, at BKR we have a dedicated department for ESG and sustainability, so we can marry that together with our expertise within the charities and academy sector to ensure that you have the necessary plan in place. Moving forward now, to just look at financial requirements. There's again a lot of links here. It really will make your life easier if you are spending time within the handbook and disseminating this information. There's a lot of regarding guidance and support surrounding procurement procedures and practice. And the reason for that is, again, section 2.23 within the handbook is the requirement, the must requirement, that the Academy Trust must be able to show that public funds have been used as intended. So you have a duty, it's part of your list of musts, and we need to make sure that that is the case, and we have tools here that can help you. The other point just under the financial requirements is in relation to clarification of the roles and responsibilities of the board in setting executive pay. We need to ensure it's a robust, evidence-based process that goes through the relevant scrutiny, and in instances where individuals are also on the board, such as the head teachers, where pay is being set, ensure that any individuals are suitably excluded from any decisions. It's common sense, but it's just making sure that this is fully documented. Just under the heading of regulatory concerns, we'll touch on this in a little bit more detail later. Internal scrutiny is they're just clarifying that when you look at internal scrutiny and you come to look at the thresholds, that the you're looking at the most recent set of audited accounts. So if you're taking an internal scrutiny that's occurring within the next couple of months, we will be looking at the 2024 year-end audited accounts. From January onwards, we'll be looking at the set that we're just about to go through and audit within the next few months. The threshold again we're looking at, we'll go into a bit more detail, but essentially, if you've got over £50 million worth of income of turnover, you have to buy in or employ an internal auditor. You can't rely on peer-to-peer reviews. Again, second bullet point under that heading, confirmation that DfE may recover funds where there's evidence of irregularity and fraud. We spoke about that earlier. But there's a specific point that's been detailed below in relation to cyber ransomware demands. If the trust does get a ransomware request coming through, the National Crime Agency recommends that this is not paid, and it's not just a should, it's a must. It's according, and they're following, and what the DfE do here are following the NCA recommendations. Briefly, it is their opinion that it doesn't help. You're unlikely to get your data back, and also it encourages further invasive attacks. And then again, I've said this quite a bit, provision of links with further information on DfE oversight and support. There is a document entitled that. The link was within the Academy Trust Handbook. If you look at the first section, there's within there is changes from the previous sector. There are links that you can follow through. It's a very easy to use document, and please do again make use of this. It will make your life a lot easier going forward. And now we're looking at the Academy's Accounts Direction, and I'll hand to Carly.
Thank you. So Academy's Accounts Direction 24-25, or the AAD 24-25, as you'll know, it's split into three key elements. So as I said, the AAD 24-25, then we have the model accounts, which of course are key in preparing the accounts each year for submission to the DfE, and the trust are not the only people that use the model accounts, but of course we as auditors in preparing the accounts for trust will use the model accounts as a guide from the DfE as well. And then in support of that, there's also the framework and guidance for external auditors and reporting accountants of Academy Trust too. Other reference material, of course, we've just covered the ATH and the changes that have just occurred. key areas of non-compliance, and good practice guides issued by the DfE too. The NCR, or the Novel, Contentious and Repercussive Transactions guide, was updated in August 25. Although it's non-exhaustive, it does outline key factors to consider rather than providing definitive answers. There are guides on various areas, but trusts can therefore now make use of the guides on fraud, novel and contentious payments, etc. On the AAD update, there are various points to consider, and as you can see here, the key elements are listed. First of all, just to talk about the Companies Act 2006, we know now that there's going to be a requirement for non-financial and sustainability information within the strategic report to be disclosed for trusts with turnover of £500 million or above, and not all, and staff numbers of 500 or more. We know that this requirement is not reflected in the model accounts, and smaller trusts can choose to voluntarily adopt or disclose the enhanced transparency and accountability in disclosing the non-financial and sustainability information. What do we mean by sustainability information? Of course, it's quite a grey area. There are various elements that this could include, an example of which could be the makeup of the board and inclusive governance, anti-corruption and bribery, health and safety, diversity, human rights, etc. The second point that we're covering on this slide is finance leases, and I'm sure a lot of you are well aware of the changes that are being made and upcoming in the sector as well. Just to point out that, again, the model accounts have not been updated for this, but trusts that have decided to opt into disclosures and adoption of finance leases early, you need to be aware of the disclosures that need to be made. An example of that may be for minibuses or copiers, etc., where you're opting in early to show these or account for these as finance leases. So I've just made a small list of additional disclosures that you need to be aware of if this applies to you. So accounting policies, of course, areas of judgment, how are you determining that this is a finance lease? Of course, it's going to impact fixed assets, creditors, lease disclosures, and the cash flow statement as well. We now know, of course, that trusts are allowed to enter into finance leases on the pre-approved list issued by the DfE, which is, I think, a welcome change or a welcome update in the sector. If not on the list, then, of course, the trust needs to seek approval from the Secretary of State. Talking about the model accounts now, as we said before, there are minimal changes. I think we've covered a few areas that are not included in the model accounts that perhaps should be in some cases, but really there are minimal changes when you're looking in totality at the model accounts. In terms of internal scrutiny, Johnny touched on that before in a reference to the ATH. This is, of course, not a new requirement, but just a reminder of forthcoming enforcement, a reminder of the £50 million threshold for internal audit, which has become a must from the 1st of September 2025. So the academic year that we are now in, not the academic year that you're about to have audited as a trust. And as you know, that smaller trusts can still use scrutiny within the trust of peer-to-peer, etc. The accounting officer statement has also been reworded for in the model accounts. Main changes, of course, to reflect the fact that the ESFA has now been transferred over to the DfE. Broadened non-compliance definitions, as you'd probably expect, and updated wording for key statements, ensuring the model accounts align with the auditor's framework released from the DfE too. We are now going to cover pensions and updates to pensions. I'll hand over back to Johnny.
Thank you. It's always worth, when looking at pensions, and just neither Kylie or myself are pensions experts here, but we know how it relates to with regards to academy trusts and all the ins and outs. And out there, the valuation is done, as you will sure be aware, by a specialist actuary. But it's always worth having a great little understanding of the two different pension schemes that the Academy Trust operate. We've got the Teachers' Pension Scheme versus the Local Government Pension Scheme, the LGPS. That's on the screen. We have the key parts of each scheme. They're both a statutory scheme. They're both defined benefit scheme. Then we start coming to the differences. It's an England and Wales scheme and the Scottish scheme for the Teachers' Pension Scheme, whereas the LGPS is divided into 97 regional funds. The key difference, I think, here with regards to accounting is that TPS is individual employers are not tracked, whereas individual employers are tracked in the LGPS, and that is why we have different reporting requirements for both schemes. Again, we have it's unfunded, there's no assets, whereas the LGPS is funded. It's government administered, it's locally administered. The contributions, you will be paying contributions to both. The Teachers' Pension Scheme is set centrally, and the LGPS is dependent on your local authority. But because the individual employers are tracked and it's funded, there is a value that can be attributed to each individual LGPS scheme, and that is why we're reporting on that. The liability, or used to always be a liability. Now it's a little bit more of a grey area within the financial statements. So most of the talking with regarding to this pension update is now going to be referred to in the local government pension scheme. This is valued. There's a formal valuation that takes place every 3 years. The last triennial valuation took place in March 2025. So the next year's accounts, as in 25-26, is going to include the most recent formal funding valuations. That might be better represented in the following slide. We've had the funding valuation in year 0, and going forwards, 2026, 25-26 is year 1, and so on. So where we are for 2025, it's the last year of the March 22 valuation. What does that mean for trusts? Not too much really, but we're going off a historical valuation that is then projected forwards. So the figures from 25, so every 3 years, the valuation could have larger fluctuations. We may be seeing that in 25-26, but it's way too soon to speculate wildly on that at the moment. Other points with regards to the pension update. The middle bullet point, discount rates have increased from 4.25 to 5.8%. So when the actuaries value your individual pension schemes, they look at a lot of assumptions, and the one that has the most fluctuation and bearing on the LGPS valuation is the discount rates. It's linked to government bonds and borrowing figures, and has increased by 1.5% approximately since last year. Doesn't sound like much, but it's essentially what it will drive the movements that we're going to be seeing in the pension valuations this year. And what it will do is it will increase the assets that are held, so you're less likely to see a liability within your LGPS valuation. It's more likely to be an asset. So what do we do when we come onto these assets or under the asset ceilings heading. So the actuaries are saying that many assets could be seeing a net asset position, and it's the economic, what an asset ceiling is the economic benefit for future contributions. As auditors and accountants and as trustees and the part of the senior leadership team and business managers, the question is, should we recognise this asset on the balance sheet? That's the ultimate question. Do employers have any control over the contribution rates that are set? I'm yet to see any local authority who has acted on a request for a reduction in contribution rates, but I don't hold my breath. Ultimately, our understanding, and this is backed by our independent pension experts, that an asset is only going to be recognised, well, that we do not recognise any pension assets at the moment. An asset, to get a little bit technical regarding accounting here, an asset should only be recognised when there either will be a cash benefit, i.e. lump sum to an academy trust, or there will be a definite reduction in future contributions. So there's going to be, again, a reduction in cash spent. We don't think, and this is corroborated by external advice from our independent specialists, that meets the threshold to recognise an asset on the balance sheet in relation to pensions. What will happen though is if your pension actuarial report is showing an asset position, it will be shown as a note within the note of the accounts as a contingent asset, with an explanation as to why that's the case. And I know that's happened quite a few of academy trusts that we've audited for the past year or so, and it's likely to happen more and more, especially while these discount rates are so high. Just going forward, I'm not going to go through this slide in a huge amount of detail, but this essentially is how the valuation is done at the back end by the actuaries. You get a valuation of the assets as at 2024, plus they take the opening balance of 2024, add on the investment returns, contributions, most employees and employers, take off the benefits. It gives you to an expected position as at 31st of August 2025, and then plus or minus your excess investment return. That calculates what the asset position for the trust is. Essentially then we do the same for the obligations, the liabilities, interest costs, employee contributions, service costs, how much it costs to administer, benefits paid out, changes in assumptions, and we get a liability figure, what your total obligations are, and then adding those two together, you'll either be in an asset position or a liability position. 4 or 5 years ago, massive liabilities were on all the balance sheets. Now we're in a position, because of the discount rate moving up from what historically was around 1.52% to almost triple that. In some cases, we're going to see a lot of asset positions on the pension reports. And therefore our advice from our external independent providers is that won't be shown on your balance sheet. It's not cash that you can readily take. You're not in control of it. It will instead go as a contingent asset. Now Carly is going to kick off looking at the sector updates.
Thank you. So in terms of sector updates, we just wanted to start with current risks that the sector is facing, in our opinion, and this has been widely discussed. So you can see on the table, if I take the top left square, finance risk, it's obvious to say larger mats, even some larger mats, sorry, are having to make decisions that may affect the classroom in terms of financial decisions. Smaller mats and SATs, many can't cope with ongoing deficits. We're seeing that even more as this audit season progresses. Increased pressure to join a large MAT, form one with other SAPs or a local authority school or schools, plural, that are due to convert to academies. Central government, significant pressures, obviously on the government in terms of spending, and therefore increased risks that not all of the cost increases will be met with the increased funding. What we're seeing that there's not enough funding to safeguard against cyber risk and maintain estates, which is obviously a key element which Johnny touched on earlier. What should you be looking at? Key focus on KPIs and efficiency of your staffing models. We're seeing as auditors, of course, declining reserves. Are the assumptions in the financial forecast correct? Are sensitivity analysis, is a sensitivity analysis being performed? Is the other income generating, is there other income generating activities? But if there are other income streams, then you've got to be careful, of course, on the VAT side, the tax side, the regularity issues as well, which, of course, I'm sure you're aware of for your trusts. Going on to the second square on the right, the send point. We know, of course, that LA funding is decreasing, insufficient numbers in alternative provisions and special schools. There's an increased reliance on schools to identify issues and provide support. And of course, there's a cash lag, in identifying issues and receiving funding for those issues. We're seeing the setting up of informal provisions between hubs of local schools. Then going on to the operations box, bottom left, we know there's been a poor historical investment, ineffective management and declining funds for future investment. And we also know there's an increased risk of cyber attacks as well, particularly as there's the end of life for Windows 10 as a current point to be aware of. As auditors, we need to understand the IT environment. That's why you may have seen a lot of questions in the last year or so regarding the Trust's IT environment and the controls that have been adopted in the IT environment. Trust should be instant recording, of course, monitoring trends and training, and also centrally managing CPD and monitoring CPD as well. In terms of staffing, the last box on this slide, we know it's harder to recruit externally and of course more expensive too. Are you looking at exit interviews as a trust? Are you learning to be a better employer as a trust? And are you monitoring staff retention levels at trust level? Of course, that's relevant only to MAPs, that those staff retention levels shouldn't be monitored just locally, but also at trust level too. Next slide talks about the Charities SORP 2026. I'm sure all of you are aware of the upcoming changes. We know, of course, that this is for financial period starting on or after 1st of January 2026. And of course, that means for Academy Trusts, that's effective from the 1st of September 2026. So not the year that's currently being audited, 24-25, and not next year's audit, which will be 25-26, but the following year's audit, 26-27, where we have to consider these updates. But trusts do need to be aware of them now and start thinking about how this may affect your accounting for certain areas. Expected changes, we know there's revenue recognition changes, which Johnny will touch on in more detail in a minute. Lease accounting, which we spoke about briefly before, and I'll go through a couple more points in terms of changes to lease accounting in a minute as well. There's tiered reporting to consider, the trustees report changes and changes to the cash flow statements as well. Just to make you aware that we will be circulating BKL guidance on the upcoming FRS 102 changes in due course, and we are running a general FRS 102 update webinar on Thursday the 28th of October if you would like to sign up to that too. So
just to look then at starting off by looking at revenue recognition. Just on the previous slide, the heading was expected changes. The reason why that is it's not been, the SORP hasn't formally been approved yet. We're expecting formal approval due imminently, but there's what we're going to talk through is very 99% likely to be relevant, albeit within the next couple of years for academy trusts. So we have a 5-step model here for recognising revenue. So this is linked to the income that the charity receives for goods and services supplied under contracts with third parties. Now that is not entirely relevant for academy trusts, and therefore the impact on understanding this 5-step model for academies is going to be minimal. Most of your income will come through grant income, the various grant incomes, and we're really looking at only the ancillary income as to seeing if this is applied to yourselves. In certain instances where you're selling goods such as uniforms, then it 100% will be, although that very much is very much a very low level income source. Boarding fees, again, it's a very doesn't happen that with many trusts, but that could be caught under this 5-step model. Trips, again, we're not sure, but essentially we have to go through these five processes of identifying contract with the customer, determining exactly what goods or services you promised, to work out a transaction price and allocate that to what you're delivering, and then you recognise the revenue once the transfer of goods and services happens to the customer. And it's currently being worked out behind the scenes as to the impact on academies. Currently, we think it's minimal, but as soon as we get general consensus across the sector within the auditors forum that we're a part of, then that will of course be communicated directly to yourselves.
Just to go on to leases now, and specifically capitalising operating leases, which we spoke about before, before I spoke about any trusts that may be early adopting, and of course also the pre-approved list that's been circulated now from the DfE regarding finance leases. Of course, the changes in Charities SORP will mean that most leases, will now be on the balance sheet, and of course that's going to affect different areas of both the balance sheet and of course the SOFA, as you can see in this table here. Of course, there are exceptions to that, and those really relate to short-term and low-value leases. When we say short-term, really 12 months or less we're looking at to run from the commencement date. Just a little bit more about those exceptions. As I say, short-term leases, beware of options in the contracts and subleases. So for example, if there are purchase options, then your lease may not fall into that exception, whereas otherwise it may have done. And in terms of low-value assets, there's no set threshold. Focus on the individual asset rather than the definition of a low value. In the exposure draft for FRS 102, it currently lists assets that would not be of low value rather than those that they would consider low value. So those that would not be of low value, an example of that, coaches, cars, lorries, etc. There's a longer list that you can see online, but those are just some of the items that may be relevant to academy trusts. As it's quite clear, we're waiting on DfE requirements for more guidance on this area.
Moving on now to look at tiered reporting. Again, this is from the 2026 SORP exposure draft, and it's looking at the different reporting requirements for charities applying accruals accounting with various different bits of various different levels of gross income. Historically, the split was smaller charities, anything under 500k, and larger charities, anything over 500k. But now we're applying 3 different tiers. Tier 1 is gross income between £500,000 or less. Tier 2 is anything from £500,000 up to 15 million, and Tier 3, the highest, would be anything over 15 million. And whilst this will come in some form, it's not, the tiers are not fully set in stone. The value, ultimately, the thresholds, whether they apply to Tier 1, 2, or 3. Essentially, if you are within Tier 2, you have to comply with everything in Tier 2 and everything in Tier 1, and it's all built up. So that obviously the most disclosure and compliance requirements for charities and ultimately academies will be brought into this, as they're linked to the Charities SORP. The accounting is going to be that. We say a good proportion of academy sectors will be within Tier 3. Again, we're looking at the income thresholds. Some of you will be sitting there thinking I'm nowhere near 15 million. Others will obviously be thinking, yes, I'm definitely going to be caught by it. As maths are obviously being continue to be pushed, then most multi-academy trusts will fall within Tier 3. What my initial thoughts as well is there could be a point where trusts are flip-flopping out of Tier 1 and Tier 2 and Tier 3, depending on like capital funding. You could potentially get in a big capital grant one year, which pushes you into Tier 3, and what will be the impact of that? Schools joining small mats. It could be a small two school mat, and then the school joins. You bring in all of their asset values as income in 1 year, and then you will be Tier 3 1 year, and then flipping back to Tier 2. So these are all things that will need to be considered and need to be finalised as we go on. But ultimately, we're still, again, as we've said 2 or 3 times before in this sector, we're still rating on the ultimate charity SORP, and the DFE requirements will come out of that once it's fully finalised. The main differences at the moment with regards to tier reporting will be within the trustees' report. There's going to be no major changes. You're not going to be, if you're in Tier 1, or you're not going to have to suddenly have huge things redacted. It will be more at the higher level. The higher level being, and the main difference we're getting is with regards to sustainability. It's encouraged at the moment in the SORP for charities within Tier 1 and Tier 2, and it's compulsory for Tier 3 charities, being that is how the charity is responding to and managing environmental, governance and social matters, and SECR disclosures as well. The DFE may, of course, mandate this fully across the academy sector. We don't know, but as soon as we do, we will of course let you know. And then again, just a reminder that we will work closely with our sustainability and ESG team to ensure that we will get the full updates out to you and help you as much as possible with regards to ensuring that this is the case. Moving on now to look at, again, under the banding of tier reporting and the cash flow statement. There may be exemptions coming in for tiers 1 and 2, as long as you're classified as a small entity. Tier 3 must provide a cash flow statement, but again, falling back on the proviso, DFE may mandate compliance, as they currently do, to ensure that a cash flow statement is required for all academy trust sets of accounts.
We just wanted to touch on internal scrutiny. As you know, and as I said before, the ATH 2024 now includes the requirement for MATs with turnover over £50 million to have in-house or outsourced internal audit functions, and they've also issued an internal scrutiny of good practice guide, providing more guidance. It's just very interesting to look at this table and to understand the fact that the finance reviews have reduced substantially over the years. That finance percentage used to be much higher, but now trusts quite rightly are looking at other areas, non-financial areas. You can see there's HR as a small percentage, estates as a small percentage, which I'm sure will grow in the next few years. Payroll is, of course, in there is 6%, IT 8%. That might grow when cybersecurity becomes perhaps a bigger topic than it already is. So it's just quite interesting to understand the trends here, and the fact that non-financial areas are being looked at quite rightly within trusts. And of course, as you know, you should be referring to the risk register to decide on your internal scrutiny programme each year. It is recommended, of course, that a review takes place each term, although that's not a must, because of course you are busy with the audit in the autumn term, so you may wish to wait to have the autumn term review at the beginning of the next calendar year. Sector updates. So we're looking at funding and costs here, just to be as brief as we can. The National Funding Formula funding increase and issues with that. So we know there's been falling rolls. We're expecting cost increases to exceed funding increases. Currently, the additional grants, current additional grants are being rolled into the National Funding Formula. So although the headline is that the grant income is increasing, if you actually look at it in aggregate, we're expecting that, as I say, cost increases will exceed funding increases. We are expecting minimum per pupil funding level to increase only by 0.5% for 25-26, after taking into account older grants that are now rolled into the National Funding Formula, and that trusts are going to be having to use current healthy reserves and pausing of urgent projects. As Johnny said before, the DfE can intervene. What does it look like if they do intervene? And there are obviously a few options. You can agree to a MAP move if needed. They'll issue a notice to improve an NTI and force a MAP move. Or the trust will agree to and have to keep to producing a balanced budget for the year after next. And in that, the DfE will be looking at detailed cash flow forecasts, etc., in monitoring the trust going forward. As you can see here, it's been reported that nearly half of heads expect to cut teachers. We also know there's more FSM pupils expected from September 26, but no new funding, and pupil premium eligibility has been frozen. Just a few facts which were issued middle of this calendar year, so mid-2025. 81% of MATs are now fully centralised. 31% of trusts are holding less than 5% reserves, and 58% of trusts reported deficits in 23-24. So that just extends the picture of the funding outlook and the costs and the struggles perhaps that some trusts are facing going into this academic year.
Just finally then some other points. Just very briefly, what trusts need to be aware of. Firstly, emphasise the need for an asset management plan. You have a responsibility to ensure that your estates and assets are fully compliant and with relevant regulations such as cybersecurity, but they're also fit for purpose for ensuring to provide education for the children, and in certain cases, especially when dealing with a large MAP, we look at a lot of replacement plans for new buildings, etc., and making sure that you have the funding. We just heard from Kylie about a bleak funding outlook as to how assets are going to be managed going forwards. We've talked on the core digital standards and IT generally, just making sure that these are you're working towards meeting these by 2030. I'm linking AI risk to that. Obviously, a lot of AI is being implemented into how we work and how we operate and how we live going forward. That will need to be addressed, but by the school and as part of the wider IT and cyber security plans. Again, waste regulations from March 2025. If you're not already recycling, it's now mandated. We need to make sure that this is in place. It occurs in every workplace, which of course academies are. And then just to highlight finally that the HMRC are again showing interest in self-employment rules. So music teachers, just make sure if you're dealing with contractors, you're using the HMRC self-employment tool as a guide. It's not gospel, but it is a guide, and you need to ensure that you are fully okay with assigning somebody as being a self-employed as opposed to an employee.
Just to round everything up, our current clients will be aware that we can help in various areas. You'll be aware that we have tax specialists, particularly around tax issues on VAT, payroll, corporation tax, and we do run a free helpline service for our academy clients. So if you have an ad hoc question, we always encourage a phone call or an email, and usually the questions are around those areas. Trustee training we can provide, and please ask us if you need more detail on that. Of course, costs are dependent on the exact need of the training. Internal scrutiny, of course, we can't provide that if we are the external auditor to the trust, but otherwise we can provide internal scrutiny in various areas, also non-financial areas such as cybersecurity, IT, recruitment, etc., because we have specialists in those areas at BKL. You'll know that, of course, we can help with NXG audits, due diligence, particularly where a MAT is thinking about bringing a new school or academy into the trust. Setting up subsidiary companies we can advise on, budget forecast returns, SCCR reporting, which Johnny spoke about a few times in this presentation, and also gender pay gap reporting. I know that we have got 3 minutes to go, and we were sent in 2 questions before the webinar started. So I'll start with the first question, which was from Kamla. That registered trusts, how should you apportion business and non-business lettings? So Johnny, if you just wanted to touch on that briefly.
Yes, so the answer is there's no hard and fast rule as to you must be using this specific metric for apportioning your VAT. Again, it follows the partial exemption rules. I mean, the easiest way would be to look at income, but there's lots of other different ways you could do it. If you're looking at usage of buildings, if you're looking at specific lettings, usage of buildings, potential. If it's more of a long-term apportionment, you could be looking at square footage. Ultimately, there is, as long as you can justify it, HMRC are usually happy with it. We have a VAT team within BKL, a couple of guys of which have dealt with a lot of partial exemptions for academies. So for specific details, please do reach out to myself, Carly, or whoever your usual contact is at BKL, and we can have a discussion. And if we want to go down a formal valuation route, we've got the capability and expertise in-house to do that.
Thank you. The second question that we got before the webinar started was, how likely is it that the rule that employees can't be directors will change to a must? We think the answer's it won't change to a must, and really that's to protect the smaller trusts, particularly SATs, primary trusts, trusts made up of primary schools, etc., where actually that just can't be possible because you don't have enough people involved. So we feel actually it's going to remain a should, maybe a strong should. If the trusts are showing that they are trying to improve the situation and minuting actions to be taken, then we feel that the DfE will be happy with that if you're not complying with that should already. There was a follow-up question as well to that point. Does the internal scrutiny work need to focus on annually on financial management? The answer is no. As I said before, I showed you the various areas that internal scrutiny can focus on and has been focused on in the sector over the last year or so. It is advisable that each year you have at least one financial review, but as I said before, it is dependent on your risk report and what the relevant committee feel the internal scrutiny programme, should focus on for that year. So it's not a hard and fast rule. It's advisable, but you don't have to have a financial review each year. I think we've just come up to 2 o'clock, so if there are no other questions, thank you for listening, and we will be circulating the slides and a follow-up email following this webinar. So as always, as Johnny said before, reach out to your relevant and usual contact within our team for any follow-up questions, and thank you for listening.